Hey there. Today we're going to talk about Chapter 11, Current Liabilities and Payroll. And so let's get started. So as we know from previous chapters, liabilities are debts that are owed to creditors. And here's a little bit about some of the three main characteristics. They occur as a result of a past transaction or event. They present an obligation for future payments of cash or services, and they are unavoidable. In previous chapters, we've talked about the difference between current and long-term liabilities. And remember that sometimes a liability is broken into two pieces. If, for example, we have a notes payable and there's amounts that are due every single year, we only look at the amount that's going to be due in the upcoming next 365 days and treat that as current, and the remainder of it would be considered non-current. So what if we had to pay $100,000 a year for 4 years? Well, the $100,000 that we're about to pay in the upcoming year would be considered a current liability, and the remaining $300,000 would be considered non-current liabilities. Here's some examples of current liabilities. We have our accounts payable, which are informal. Sales tax payable, we'll talk about that in a second. Unearned revenue, you should be familiar with that from previous lectures and videos that we've done. And long-term liabilities would include things such as a notes payable, which is more formal than an accounts payable, a mortgage payable, and bonds payable. So when we're talking about sales tax, this is something that's collected by retailers and then is submitted to the taxing authorities. So if a $10,000 sale was made by us, we're actually going to collect that sales tax of $600. So we're looking at $10,600 that we're going to collect, but $600 of it doesn't belong to us. Only the $10,000 does. This $600 belongs to Uncle Sam, and we're going to have to remit it or send it over to Uncle Sam periodically. And when we do that, our cash is going to go down by $600, and we're going to remove that liability from our books. Income taxes are also another expense that corporations encounter. As you remember from the previous discussions and from your book, corporations have to pay taxes themselves. There's a corporate tax form. It's called a Form 1120, and their tax is calculated and paid on that form. Well, once we know what the tax is, we can record the expense and also the payable that's going to exist until we actually make that payment. Okay? And we shouldn't forget that in many states there's also a state income tax. Some states such as Florida and Tennessee don't have personal income taxes, and there are certain states that have different tax rates for corporations, and some might have no tax rates as well for corporations. But we need to keep in mind, depending on what state we're in, that there's likely going to be a corporate tax amount that's going to be due as well. So, unearned revenues. I think I made a video just talking about unearned revenues and prepayment, so you should go back and take a look at that. But just in a nutshell, remember that in this example, and in any circumstance where we have unearned revenue, we receive the cash before we perform the service. So if we receive cash and we haven't earned the revenue, we can't increase our equity yet. So instead, we increase this liability. So in this case, we had an asset that went up, and on the other side of the accounting equation, we had a liability that went up. And then once we pay it, then as we earn it piece by piece, we're slowly going to reduce that liability and slowly increase our equity. Alright, so now we're looking at an example where we purchased inventory and we didn't have the cash for it. So instead, a notes payable was drafted, and it says it's for 90 days and there's 10% interest. So we have 90 days. When we actually pay it, we're going to pay $8,200. $8,000 for the inventory, and then the interest expense is going to be $8,000 times 10%, and then 90 out of 360, which is going to give us $200. Okay, now we're going to take a second to talk about payroll. We're just going to scratch the surface in this book. If you're taking the business administration program, a class we offer is a payroll tax accounting class, and or a payroll accounting class, and you'll get into a lot more detail on that. This is pretty complicated stuff, but we're just going to kind of scratch the surface here. And feel free to pause the screen if you want and read through all this stuff. And it talks basically about the differences between different types of compensation that an employee might get. Salaries expressed in dollars per year. So for example, I make $350,000 as a faculty member here at the community college. Just kidding, it's far, far less than that. I'm just playing with you. But it's stated as an annual amount, like I make X amount per month or X amount per year. Wages are stated hourly, such as maybe if you work at a fast food place, for example, you might get $8 an hour or $12 an hour or something like that. And commissions typically are something that salespeople get, and it's more incentive based. So the more productive they are, the more they're going to make in commissions. Sometimes employees or managers will get bonuses if they meet a certain target. For example, maybe a CEO will get a $10 million bonus if they reach a net income target. We've talked before about some of the temptations that might lead management to kind of fudge the numbers, okay? And then we talk about here at the bottom extra benefits such as life insurance, health insurance, different things like that that employers might also offer. So in this example here, let's take a look at this. It says that this employee works 42 hours during the week, and his place of employment, they pay time and a half for any amount over 40 hours. Okay, so it says he earns $15 per hour, and then he's paid time and a half for overtime. The rate is 1.5 times straight line pay. So here's how we figure this out. So for the 42 hours a week he worked, he's getting $600 for those 40 hours. The $40 times $15 an hour, and then 15 times 1.5 gives us that $22.50, and we multiply that by 2, so we're looking at a total gross pay of $645. Okay, so that's just his gross pay. We're going to see in a second that there's going to be things that are subtracted from that, and that's going to be the take-home pay, aka the net pay. Alright? So you can pause this here if you want to, but basically there's different things that are subtracted from the paycheck. For example, there's likely going to be federal tax withholding, state tax withholding. We're going to talk about FICA taxes. So there are different employee taxes that are going to be withheld as well. Okay? And after all those things are subtracted out, we end up with net pay, which is the amount that the employee is going to take home. That's going to be the amount that their check is actually cut for. So when we're talking about withholding allowances, the more withholding allowances that a person has, the less amount of tax that is withheld from their paychecks, okay? Now keep in mind when we're talking about tax withholding, this is just an estimate. This is just a prepayment of taxes. And when the tax return is actually prepared, whether or not somebody gets a refund or not is dependent upon what the total tax liability is in comparison with however much has been prepaid via things such as withholding. Okay, so it's a tax return is the form that you fill out, and a tax refund is any amount that you get back from Uncle Sam if you've overpaid. If you've underpaid, you might owe money at the end of the year. So just because you get a refund or not doesn't mean that your tax is higher or lower. It's just whether you get a refund is the difference between what's been prepaid and what your tax liability actually is. So employers hang on to all of this money. Oops, I'm sorry. This has got a mind of its own. So you can see here from this slide that the employers withhold the money and for things such as those taxes and remit those to Uncle Sam. if you were given that money and then had to go pay it yourself, the odds are likely that a lot of people wouldn't, and the government would have to track them down. So instead what happens is it's simply withheld, so you just never get your hands on it. It goes straight from your employer and into Uncle Sam to the federal and to the state taxing authorities. I've mentioned this before about the origins of tax refunds. Once again, it's a federal offense to falsify withholding allowances. That's what a W-4 looks like. This is something that you would fill out at work when you first start a job and they're trying to determine how much to have withheld. And you fill it out, and basically this number of allowances here, the larger this number, the less that is withheld from your check. So the higher this number is, the less it's withheld. You might end up having to actually have a balance due. If this number is smaller, they're going to withhold more from each paycheck, and then at the end of the year, you might get you a bigger refund. All right? So here is an example of a payroll register, and we can see the beginning earnings, then the earnings for this current accounting or pay period, and then the ending earnings. We have Social Security, old age, survivor and disability insurance, Medicare, income tax, health insurance, and others. So these are all examples of withholdings. Okay, so if we look at the current period earnings and subtract out all these little guys, then our net pay is the actual amount that's going to be taken home. So the total of all these all of these right here, I'm rolling the mouse over, equal 2,612. All right? I mentioned FICA a second ago, which is comprised of OASDI, aka Social Security, and Medicare. So Social Security, or OASDI, provides payments for retirees, survivors, and disabled folks. Okay, so for 2016, the rate is 6.2% on the first $118,500 of earnings. After you reach $118,500, you no longer have to pay Social Security tax. For a lot of us right now, that's not a concern, but maybe later in life we might strike it big and get that awesome job and be in a position where that might matter. Or if we're doing work for somebody else, they might have employees that are above that range. Now, your book is going to use different figures. This is what happens to be for 2016. This is going to change most every year. I believe your book uses $117,000, and that's what you're going to want to use when you're doing your homework and quiz and tests. Medicare provides health insurance benefits for senior citizens. The 2016 rate is 1.45% on all earnings, plus if you make more than $200,000, there's an extra 0.9%, not 90%, but 0.9, 0.9% for all earnings in excess of $200,000. So let's take a look at an example here. If somebody's in a position where they're getting really close to that threshold, if they're clearly under it, they're going to pay the 6.2%. But if they have a paycheck that straddles where part of it's below and part of it is above the threshold, then we're going to take a look here. This guy's getting paid before this payment goes through. He's already accumulated $112,700, and once he reaches $117,000, then anything above that is not going to be taxed. So he's getting paid $10,000, but of that $10,000, only $4,300 is going to be below that threshold. Okay, and so we're going to multiply that by 6.2%. So we're going to have $267 withheld there. And let's take a look here. And so for Medicare, there's no maximum, there's no ceiling to it. So the full $10,000 is going to be subject to that. So the $267 plus the $145 is the total of the FICA tax, which is $412. And we can see that right here, right? So this was the $10,000 earnings. This is how much you had before. And so this one right here is the only one that's close to the $117,000. All these other ones down here, they are all going to have to pay the full amount because they haven't gotten above that ceiling for Social Security of $117,000 that your book uses. Every dollar is going to be subject to Medicare. If we factor in all these other little pieces to the puzzle, that we've calculated employee health insurance, and maybe he has $20 that's withheld from his earnings and given to United Way, then this is what we're looking at for the total deductions and the total take-home pay. And let's go back here and take a look. Oops, there we go, right? Total withholdings and total take-home pay, aka net pay. All right, so once again, we just talked about this James Colin fella here, but there's all these other people too. And when it's time to make the journal entry, we're going to need to take a look at all the different people collectively. And so this is our total salaries and wage expense. This is the total amount of their gross pay. We have their net pay, which is their gross pay reduced by all of these different amounts that were withheld. Okay, and this is going to be the dollar amount we're going to see that the actual check is going to have to be cut out for here in a second. So we have our wages expense, which is the total of all the gross pay, all these different payables, because all these things that we're withholding are going to become liabilities because this isn't our money. We've withheld this money, but we have to pay it to the taxing authorities and to the charity and stuff like that, right? Because this was for United Way. And so we make this entry, we're recording the expense, we're establishing these payables that are going to be there until we make the payment, and we're going to have this salary and wages payable that's going to exist until we make the payment for that. When we make the payment for those wages, and this is what's going to take place. Cash is going to go down, and we're going to show that wages and payable, salaries and wages payable, that liability is going to go away. Now, with FICA, remember that Social Security or OASDI and Medicare, not only does the employee have to pay it, but the employer has to pay it. So in essence, the full amount is split between the employer and the employee. Okay? So your employer is not happy about this, and in addition to that, they also have other types of taxes that they typically have to pay. You know how if you're laid off, you're able to draw unemployment benefits? Well, this is how that's paid for. There's taxes your employers have to pay. They have to pay FUTA and SUTA, so federal unemployment taxes and state unemployment taxes. And it says here, in recent years, employers have paid a combined tax of 6% on the first $7,000 of each employee's annual earnings for unemployment tax. The proportion paid to the state depends on the individual, but for many it is 5.4% to the state plus 0.6% to the federal government. Okay, and that can kind of change. The dollar amount and the rates and stuff like that can change from time to time. They've been pretty stable for a while though. And so this is the actual total cost of $1,000 of an employee. If an employee's making $1,000, they have their take-home pay would be $723. The $62, the $15, and the $200 here would all be withheld, and then the employer has to, out of their pocket. This isn't something that they're just holding on to and repaying. The employer also incurs their share of FICA, which are these two pieces here, Social Security and Medicare. They have to pay $6 for SUTA and $54 for FUTA. Okay, so in actuality, to pay somebody, if somebody makes $1,000 as an employer, by the time you tack on the extra employment taxes, it actually costs you $1,137. In this example, based upon these rates. So here we are. This table here shows the total of the employment taxes that an employer would incur, and we can see that we have the Social Security and Medicare. Now notice with FUTA and SUTA we have a bunch of zeros here. That's because it's taxed on the beginning first $7,000. There's zeros here because these people, the FUTA and SUTA would have been paid a long time ago for them in their first $7,000. That took place a long time ago. For Lisa Smart, however, this is her first. She hasn't quite gotten to the $7,000 yet, right? She started out with $0 and has only earned $4,000. So we're going to multiply that 4,000 times 0.6% and the 4,000 times the 5.4%. The next accounting period, assuming she makes another $4,000, only the first $3,000 are going to be subject to these, and then she will have met the $7,000 threshold. That additional $1,000 is not going to be subject to FUTA or SUTA. So now, based on these numbers here that we've calculated, we can prepare the journal entry. We have our payroll tax expense, and we have all of these payables. When we actually cut the checks to pay these payables are going to go away with a debit, and cash is going to be credited. Feel free to pause the screen here and take a look at the internal controls over payroll. This discusses the controls for efficiency. And here, you can pause it as well if you'd like to. These are controls to safeguard payroll disbursements. Notice that there's a separation of duty or segregation of duties here with a company that's large enough to be able to justify having people to run all these different departments. This helps keep people from defrauding the business. The last thing we're going to talk about here in this chapter is a contingent liability, and that's a potential liability that depends on a future event. So we're not sure what the outcome is going to be. And if it looks like the outcome is going to be remote or probable or reasonably possible, that's going to determine how we need to account for it. Okay? So if something is remote, it has little chance of occurring, and if that's the case, we are not going to need to record a liability or even disclose in the footnotes of the financial statements. We hear all the time of people being involved in frivolous lawsuits, and those are something that's very unlikely to actually materialize in any award being made, and so we just kind of forget about those. If they're reasonably possible, we're going to have to handle this separately. That's a case where there's a lawsuit and we stand a chance of losing, and we're not sure exactly how much it would be, and but there's a reasonable possibility. If that's the case, then in the footnotes in the back of the financial statements, we need to mention that this is taking place. And if it's probable that we're going to lose, we definitely need to include that in the notes of the financial statements. And if we can also estimate the dollar amount of it, if it's pretty likely we're going to lose and we know the dollar amount, then we're going to also need to record a liability for that, and an expense, and then a liability maybe for the payable that it's pretty likely we're going to have to pay in a lawsuit. If you have any questions, please let me know, and have a great day.